Welcome to the book, The New Rules of Investing. This is how you make a profit in today's markets. This book will let you respect the past while understanding the future. Recently, I saw a video in which someone threw away the book, The Intelligent Investor by Benjamin Graham in a reel, smashing it into a trash can. I understand why they did this. Of course, it was a provocative act, as that book is filled with wisdom. However, it is true that not all the principles from the past apply to today's times. We see stocks that are fundamentally weak rise because of hype, forcing companies shorting these stocks to pay the price. It seems illogical. We must recognize that the world around us is changing, and by understanding these changes, we can benefit from them. In this book, we'll explore how investing has changed over the years and what you need to know to succeed today. This book will provide you with valuable insights and practical strategies to navigate the ever-evolving financial landscape. Investing isn't just about making money. It's about understanding the world around us and adapting to new trends and technologies. With the rise of computers, the influence of social media, this can be overwhelming, but it's also an exciting time full of new opportunities. We'll start by looking at some timeless principles that have guided successful investors for decades. Even in a world that's always changing, some things remain the same. Next, we'll dive into common mistakes that investors make and how to avoid them. Understanding these pitfalls is crucial to making smarter decisions with your money. We'll also examine how markets have evolved with technological advancements and regulatory changes. The rise of algorithmic trading, artificial intelligence, and cryptocurrencies has transformed the way we invest. In this book, you'll learn how to leverage these innovations to your advantage. Finally, we'll discuss how you can adapt to these new financial landscapes. By staying informed, embracing technology, and developing a flexible investment strategy, you can thrive in today's complex market environment. Thank you for choosing this book. I'm excited to share these insights with you and help you on your journey to becoming a more informed and successful investor. Chapter 1. The Never-Ever-Changing World. The world is always changing. Just ask your grandparents. I recently asked my 85-year-old grandma how she feels about how the world has changed. She said it's insane. In the beginning, they had nothing, and during the war, it was even worse. They had to rebuild everything from scratch. Back then, they did everything themselves. Nowadays, there's an app or a computer for everything, and she can't keep up. She also has some shocking stories about the past. In school, you could be hit for not listening. At home, parents used belts to discipline children. Fathers, who often worked all day in the fields, had no energy left for kids misbehaving, so they solved it in a way which is not allowed in today's time. The church had more control over people than the government. When my grandma got married, church officials visited and asked, "When are you going to have children? We need more children." They almost forced you to have kids, and if you couldn't, you were treated like an outcast. The further back we go, the crazier it seems. Change is constant, and it often feels too fast. For some people, while this is understandable, history shows us that the world has always been chaotic and controlled by those in power. The difference now is that we have the power to create our own futures. Not everyone can handle this responsibility. For example, today, everyone has access to stock markets and investment opportunities. Investing is so easy now, you can start with one push of a button. In the past, only those who studied finance dared to enter the market. Going further back, ordinary working people weren't even able to get access to investing. So how did all this start? It began in my beautiful country, the Netherlands. Chapter 1.1. History of the Markets. In the early 17th century, the world was rapidly expanding. The age of exploration had opened up new trade routes, and European nations were eager to capitalize on the wealth of the East Indies. It was during this time that the Dutch East India Company, known as the VOC, United East India Company, was formed in 1602. The VOC was created to combine the efforts of several small trading companies into one powerful entity, so they could really again the strong forces of England and France and also Portugal. The traveling all around the globe was costly. so the Dutch government granted the VOC a 21-year monopoly on Dutch trade in the Asia-Pacific region, giving it unprecedented power and influence. To raise the enormous amounts of money needed for these expeditions, the VOC came up with a revolutionary idea. They would sell shares in the company to the public. This was the first time in history that a company issued stocks to the general public, allowing ordinary citizens to invest in its ventures. In return, these investors would receive a share of the profits from the company's trading activities. The initial public offering (IPO) of the VOC shares was a massive success. People from all walks of life, including merchants, craftsmen, and even the wealthy elite, lined up to buy shares. They were eager to be part of the lucrative spice trade, which promised high returns. The concept of owning a part of a company and sharing in its profits was novel and exciting, sparking a wave of enthusiasm and speculation. This new financial instrument, the stock, allowed the VOC to raise significant capital quickly. The funds were used to build ships, hire crews, and establish trading posts across Asia. The success of these ventures led to substantial profits, which were distributed to the shareholders in the form of dividends. The VOC's innovative approach to raising capital and distributing profits laid the groundwork for modern stock markets. The trading of VOC shares didn't just stop at the initial offering. Investors soon realized that they could buy and sell these shares to each other depending on their expectations of the company's future performance. This secondary market for shares led to the establishment of the first stock exchange in Amsterdam, where brokers and investors gathered to trade VOC shares and other securities. The Amsterdam Stock Exchange became the world's first official stock market. It provided a central place where shares could be bought and sold, prices could be determined, and information about the company's performance could be shared. This development marked the beginning of the modern financial markets as we know them today. The VOC's creation of tradable shares and the establishment of the Amsterdam Stock Exchange were pivotal moments in financial history. They introduced the concept of joint ownership in business ventures and created a platform for the buying and selling of financial instruments. This innovation not only financed the expansion of global trade but also laid the foundation for the complex and interconnected world of modern investing. Chapter 1.2 Key Economic Theories, Investing Philosophies. We spoke about the history of the markets. Since then, a lot of things have changed, and when something changes, the people have to change as well. This doesn't mean we have to throw out all investing philosophies. Mostly they are still usable. It's important to know what always stays relevant in every economics investing climate. So, even though the world of investing has changed a lot over the years, some economic theories are still very important and useful today. These theories help us understand how markets work and how we can make smart investment decisions. One of the economic theories explains how the price of something goes up when there's a lot of demand for it but not enough supply. Conversely, prices drop when there's a lot of supply but not enough demand. This theory helps investors understand price movements in the stock market and are pure, factual, and are helpful since the start. Furthermore, there is a theory what says that if you keep investing in something, each additional investment will bring you less return than the previous one. It's important for investors to know when to stop putting more money into a particular investment. Furthermore, you have to know that all known information about investment opportunities is already reflected in stock prices. That is because investors try to predict future events based on what is known today. According to EMH, efficient market hypothesis, it's hard to consistently outperform the market because stock prices should only react to new information. This helps investors understand the challenges of beating the market through stock picking. One last key economic theory is that investors can reduce risk by spreading their investments across different assets. Diversification helps balance out the risk because when one investment goes down, another might go up and vice versa. Many successful investors have shared their strategies, and these have stood the test of time. Learning from their approaches can help us make better investment decisions. Further in this book, we will talk about the regulatory developments, electronic trading, and high-frequency trading, and how to benefit from today's market. The part you listen to is the free part of my book. If you are interested in the complete book, please go to my Etsy page via the link in the description. And don't forget to subscribe and follow my channel for more books to come.